down payment on a house, paying down student debt, and those are parts of life, right, that aren't going away. So I think it's just going to be more and more market participants, and we'll soon see kind of this wave of new companies that have grown really fast in the private markets, as Atish alluded to.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of Alternative Investor Mastermind. Really excited today to have the co-founders of Equity Zen, Phil and Atish. Equity Zen is one of the largest platforms for pre-IPO shares, has more than 650,000 subscribers, and has closed more than 40,000 transactions and served more than 450 companies. So guys, thank you so much for coming on the show.
Glad to be here.
Thanks.
Awesome. Well, I always like to kind of get the origin story. Always curious how people fall into all these niches of alternative investments. So if you guys don't mind, just take a few minutes just to talk about your backgrounds, your career paths, and how you founded Equity Zen.
Yeah, happy to start, and I'll kick it over to Phil after. So hey everyone, my name's Atish, one of the founders of Equity Zen. Look, I was I grew up in India. Was born and brought up there, moved over to the U.S. Right before college. My experience, candidly, in the U.S. was very much of actually getting a chance to live out the American dream. I got a chance to study computer engineering, mathematics, finance in undergrad. It was a pretty cool experience. My first job out of school was at a quant hedge fund. Timing wasn't so great. It was 2008 when I graduated, and so I definitely got to see kind of both ends of the market, both in the beginning of the year and the end of the year. But one of my cool projects at the hedge fund was to take these really sophisticated, $50 million minimum strategies that these pension funds and endowments would get to invest in, and convert them into a mutual fund so that my mom could invest in it with $2,500 on Vanguard. And that idea just really, I think it just never left me. It just really took a hold of the art of the possible. And candidly, it's a little bit of what we do now at Equity Zen. But before Equity Zen, I left the hedge fund, joined another startup as its early employee. Both in that company and a few others, I had earned a little bit of sweat equity, and I wasn't making the hedge fund bucks anymore. And so I wanted to propose to my then girlfriend. I tried to shop around for an engagement ring. It turns out they're very expensive. Sold, tried to sell some of my shares. I went to brokers back in the day. I went to any rich individuals I knew, and just tried every which way. And it turns out, if I had $10 million worth of shares, there was a solution for that. If I had $10,000 worth of shares, there was no solution for that. That was really the genesis of what has now become Equity Zen. Maybe I'll kick it over to Phil, who's one of my co-founders and someone I called up and convinced to quit a pretty cushy job where he was working 9 to 5 to basically work 5 to 9 for no money with me. I have to say that was 12 years ago, so it's been quite a ride. I'll let Phil introduce himself and the company.
Yeah, thanks, Atish. Well, my story is far less exciting, but I do get the liberty of letting you know that Atish's then girlfriend at the time is now his wife and mother of his 2 very beautiful kids. So it all has a happy ending so far. But my story kind of out of college was that, similar to Atish, at a slightly precarious time in finance, I went into financial services in 2009. I worked at Barclays Capital, and I started working on a trading desk that did a lot of esoteric products, a lot of really illiquid things that were out there. So credit default swaps, just really weird things that required a lot of market structuring to create liquidity. And so what I learned over time is that if you've got pent up needs to buy something and sell something, that's a good indicator there's a chance to create a market, but it requires a lot of structuring, a lot of work. So when Atish caught me up on what he was doing with Equity Zen and the conundrum he found with trying to finance the engagement ring. I let him know that from the institutional side of things, there's kind of a playbook, which is you identify what the big roadblocks are to make that market. You try to find the right counterparties to make it happen. And knowing, admittedly, very little about venture capital and kind of the private tech space, we were able to get something going with Equity Zen. So that was kind of the genesis story. And as Atish mentioned, it was a lot of gray hairs ago, and been a really good ride so far.
Yeah, it's super impressive what you guys built, and when I saw the company cross my desk, because I actually coincidentally graduated right after the .com crisis, and then a few years later ended up on Wall Street buying non-performing mortgages, and saw some smatterings of secondary markets being built around a relatively new industry. So when I've seen the scale that you've gotten with building this market, I was very, very impressed, and I'm excited to dive a little further into it here. So you're the two co-founders, started in 2013. You're really a couple of years removed from the financial crisis, but you started, the companies that survived, and you started to see kind of the beginnings of, I guess, I don't know if it's really a tech bubble other than maybe a little pullback last year for a period of time. It's been a pretty crazy run. What was the first year like, and who did you go after first? Was it lining up the employees that wanted liquidity, the companies that would allow them, the investors first? Like, what was the chicken or the egg there?
Well, first, let me just address your point about the tech bubble. As I understand, a lot of the listeners, of your show are kind of focused on real estate, and tech equity could really get, you couldn't get farther from a real asset than technology equity, especially over the last 10 years. So it is absolutely the case that we were, we were watching, a real moment of change happen. Specifically for, the seat we had in the industry, candidly, it was pretty awesome because instead of focusing on primary transactions where companies are raising money, the Jobs Act has just been, converted to law. All these angel investors are all of a sudden getting interested and becoming angel investors. Our entire focus from the get-go was on secondary markets. We saw these tens of thousands of accredited investors pour into a market that previously was not accessible to them by investing in primary, in seed rounds and pre-seed rounds. And we were kind of scratching our heads saying, these are the same folks that are used to buying on Monday and selling on Thursday all these super liquid stocks. If they're entering the venture space where you don't hold for a year for cap gains, but you hold for 10 years because that's how long it takes companies to actually give you your money back, they're going to wake up years 3, 4, 5, 6, 7 and say, shoot, where can I get some liquidity? So that was really one of the most powerful kind of catalyst for what we saw from the front seat, and what that the path that led us on was to say secondary liquidity, no matter what kind of shareholder you are, whether you're an employee, whether you're a founder, whether you're an angel investor, whether you're an advisor, at some point with companies staying private longer and longer, them becoming teenagers by the time they hit public markets. Amazon was a 4-year-old company when it went public. Companies these days are well into their teens by the time they hit the public market. That's a long time to have to wait. And so how do you actually do what everyone wants to do, which is to say, hey, it's great I have paper money. How can I turn this into real money? And that's really the service that we saw ourselves adding into the industry, saying, how do we convert all this monopoly money, all this wonderful stuff that people can brag about, but they can't buy a burger with, and actually convert it into US dollars, help them diversify, either reinvest into the space or go diversify into other alternatives, whether it be real estate or credit or what have you. And I think that really was the draw for our business, and kind of got the flywheel going, to be honest, because as soon as we help someone convert their equity in a private company into cash, all of a sudden they had this cash and a question about what to do with it. And so while we haven't launched a wealth management solution ourselves, we've really been there at the moment of someone becoming coming into money for the first time. And that has just led a lot of new kind of product innovation to take place on our side. I did realize, though, we kind of jumped the gun here. Phil, maybe I'll kick it over to you to maybe explain what we do and a couple of different products that we offer.
Yeah. And I can kind of connect it to what the first, few years looked like. But the the best example I can give is probably, a real one on how people live and breathe this, which is if you go work at a tech company, you're typically getting a salary like everyone else. You're also getting stock options, which are, the opportunity to participate in the equity appreciation of the company you work for. And in a lot of instances, these companies are private for a long time. They grow in size, they raise new funding, they get bigger and bigger, and therefore, kind of on paper, you have this asset, which is your private equity in the company that's appreciated in value. At some point, you kind of pick your head up and say, "Well, I'm pretty concentrated in this one position. It would be great to have some liquidity for it. I don't know when the IPO is going to happen or if it'll ever happen. So you might look for liquidity. So you tend to kind of search online on what you can do, get educated, and we provide that education solution for people and hopefully a venue for liquidity. And the other side is probably pretty on the nose for this audience, which is, let's say you're your typical accredited investor and you want to invest in the products you believe in, the products you use every day. And you go on some type of ride sharing app and you thought it was great. 5 years ago, you do that and you take an Uber and you're like, wow, I think I should really invest in this company. That's kind of what I did with IBM and Starbucks and other things. So you go and you search in your Robinhood or Fidelity brokerage account and you search Lyft in there, you search Uber and you find nothing. The company's private and you quickly realize you're not going to be able to build that portfolio within your traditional kind of public trading account. And you know, but EquityZen or, some other venue, and you're able to match with the aforementioned group of people that said, I'd really like to exchange these shares that have good upside opportunity, but are really illiquid for cash now. And so that's really been the name of the game. It's, we kind of distill it down to being just an exchange of risk, right? That's really where trades happen. It's somebody that would prefer cash over something illiquid and somebody else would prefer the upside opportunity instead of cash. And so that's really the name of the game. First few years, though, I'll be the first to admit the platform looked nothing like it does now. At the start, you have to create a market from nothing. That's a really, really tough thing to do. And so to answer your question, Jack, kind of where'd you start first? Who'd you work with? You kind of have to do both sides. You have to convince a bunch of shareholders that maybe liquidity is a good thing and that we can find them some investors. And on the same time, we convince a bunch of investors that, oh, sure, the shares that you're looking for is something that we can help facilitate. And you kind of build it up and you try to balance it. And in different, market periods, 2021, for example, you got a lot more buyers than you have sellers. And then in slower markets like end of 22 and early 23, you got a lot more sellers than buyers. But that's just kind of how these things flow. And our job is to bring as many people into the room as possible to help catalyze that liquidity. That's kind of what any marketplace is going to do. So that's where we constantly spend our time. But, in 2013 and 2014, that was a bunch of Google Docs and Google Sheets of tracking people's interests and sending them emails at 2 a.m. And now look at us, a lot of those things happen a lot more smoothly on the front end.
I will say the very first client that we got was a shareholder. So we got something to sell first before money to go and buy it. And I remember getting the confirmation from the seller on my way to dinner to celebrate my at that point, fiance's birthday at the time. But yeah, it was we kind of started with the thing that we're selling. Let's make sure there's something real to sell, and then we'll go find the buyer. So if we ever have an extra hour, extra week, extra month worth of resources, we would devote it first to sellers and then to buyers and then back and forth, as Phil said, as with any marketplace.
That's great, and kudos to you, because I know building a two-sided market is, I think, one of the most difficult business models, and those that have done it successfully, like the Ubers and the Lyfts, and obviously the Amazons, right, have reaped the benefits. Let's talk a little bit about the investments. So you've done 41,000 transactions, and I see a couple notes here that your minimum start at $10,000. But one of the challenges I've had is, I have a few allocations to venture capital, but I'm primarily in real estate, so I don't feel like I can get enough diversification. And even though your companies are a little further along, We've seen what happened to WeWork. Are there solutions for sort of building a diverse portfolio, or even your own ETF, if you will, where someone could get exposure to multiple companies or sectors?
Yeah, well, I think the first thing you've identified, Jack, is that because it's a kind of an illiquid asset. Just throwing a bunch of $10,000 and $25,000 bets into your portfolio, you got to be prepared to do that, right? This can't be money that you're going to immediately need 3 months from now. And what I'm proud to say is that when we started, as Atish mentioned, the minimum to kind of do these things was like millions of dollars, right? And so we've fortunately been able to drive it down where you could make a 10 or sometimes even a $5,000 investment into one single company. And that's been really rewarding and gratifying for us. But if you want to take it even further and kind of say, you've got, an investor like yourself that says, okay, I believe in this space. I'd like some exposure, some diversification from real estate or what have you, but I can't build a portfolio of $10,000 investments. I'm just not in that position right now. We do also make available diversified funds as well. So they tend to be centralized around a theme. So for example, we might have an AI and machine learning fund, unsurprisingly, where someone says, okay, cool, I can put in $10,000 or $20,000, get exposure to 5, 10, 20 of these companies. It has an active manager. That way I don't have to do the full kind of company by company research, right? There's a lot of time that goes into that as well. So we launched those products in, I want to say 2015, so maybe 2 or 3 years into what we were doing. And it served as kind of a great entry point for people that aren't as familiar with the space. And that's gone really well. Down the road, something a bit more structured or, listed or something like that in your brokerage account, maybe. I think that's kind of that would be a good goal to aspire towards. As Atish mentioned, when he was at a large hedge fund, they were starting to kind of build the machinations and put that product in place for, mom and pop to get hedge fund exposure. I think it's great, it's successful. And so I think down the road, we could see that opportunity as well.
Yeah, that's great. The diversification is key. I want to ask about valuations. Obviously, these companies go through I imagine most of our listeners are familiar with like Series A, Series B. Usually each round is more expensive in a down market. It's not out of the question that there's a down round. Are you relying primarily on sort of the last third-party valuation, or can say an engineer decide kind of setting his own price? Is it a free for all, or is it somewhat structured based on where the round was on where these shares trade?
Yeah, it's well, first of all, it's worth pointing out. It's a great question. It's also worth pointing out that unlike public companies, which is what a lot of folks are kind of familiar with, where you usually have one class of shares, in private companies you can have multiple classes of shares, and it's actually quite common to have that. So the founders and the employees will have common shares, and then your Series A investor will have preferred shares, and your Series B investors will have preferred shares, and so on and so forth. But there's basically, if there's a sale or liquidation or what have you, there's a pecking order. There's a waterfall in which the equity gets worth. So the valuation is absolutely a little more complex in these private companies than it is for public companies. The way our marketplace works is we have to strike that balance between giving the participants, the sellers and buyers, the freedom to make their own decisions about where they are willing to buy and sell, and striking a balance between that and where's reality, right? Because we have a third stakeholder in our ecosystem, which is the company. So a company is not going to want their last round to have taken place at, I'm making this up, $500 million of value, and for some insider to be selling at $2 billion worth of valuation. Now, even if there was a buyer at that price, it's not the best precedent to set. It's not a great situation for the company to have that kind of pressure on it, number one. And number two, you can also see how if trades can take place anywhere, you can see how insiders can all of a sudden be tempted to share private information about the company. Start talking about, oh, we have a partnership coming up with Microsoft or so-and-so, and therefore I'm going to tell you this and you're going to give me a higher price. EquityZen's entire platform separates that. It just kind of tries to turn that off and that incentive, because what happens is, yes, people are allowed to put their bids and asks wherever they want, but most transactions take place within some range, some window of the most recent valuation. And that just keeps a sense of realism into the entire marketplace. It also allows buyers to feel more comfortable that what they're buying is not completely separated from what a bunch of institutional investors who did a bunch of research very recently, who poured over the books and said, okay, this is the price we're willing to pay. So they get to back on the diligence conducted by the investors. And the sellers get to benefit from, well, the last round was 6 months ago, but the company's experienced 30% growth since then. Shouldn't I get some of the value? So it finds a balance between not being completely open forum, but also not being so restricted that the company sets the price. That's not, and so we really try to strike that balance. And I have to say, I'm proud to say, over the last 10 years, we work with over 450 issuers at this point, so 450 companies that we've worked with, become partners with, and again, most of our transactions are repeat transactions, not first times with companies. So clearly, we found a way to strike that balance between just setting the price or a free for all.
That's great. We've touched upon this, but the market's changed a lot over the last couple of years, and you've mentioned that companies are staying private longer. Like, where do you see the outlook if you had a crystal ball? The industry over the next couple of years. Like, where is it going? We've had a pretty crazy run in tech and AI in general. Nvidia is going absolutely crazy right now.
Yeah.
Where are you positioning the business? Where do you see some trends?
Yeah, look, I think we're very likely going to see a continuation of only the strongest companies are going to find their way into the public markets, right? I mean, 2020, 2021, there were so many companies that found an exit, started trading publicly or got bought. And candidly, many companies probably weren't ready to be public companies at the time. And so this correction that we've seen over the last couple of years, I would argue has been a very welcome thing for the industry. Yes, some companies are raising down rounds, and some companies have had a really tough time. However, in terms of the health of the ecosystem, it's actually a really good thing for there to be a purge every now and then, and for prices to kind of come back down to fundamentals. I'll maybe start off with one of the trends that we've seen, and Phil, I'm sure has a lot more. We're starting to see a lot of demand for kind of the youngest companies, like the companies that have started in the last 3 to 4 years, but have demonstrated high performance. Unsurprisingly, this tends to be in artificial intelligence as opposed to or in future of food as opposed to sectors that were really popular, like consumer sectors or fintech sectors 6 years ago, 7 years ago. If you think about like a cybersecurity sector, over the last few years, the demand on cybersecurity has only increased. And so you have these 2, 3, 4-year-old companies seeing a lot of demand. And then you have the kind of the older companies, kind of the old guard seeing demand because they're kind of the blue chip or value version within this private ecosystem. They've seen ups and downs. They've been around. They've managed to survive through multiple cycles. The ones that were founded in 08, 09, 2010, they saw the whole run up and they continued to survive after that. So there's this barbell that is seeing a lot of demand. And the companies that on average are not seeing as much demand are kind of this, the companies that are in the middle age. They haven't quite hit escape velocity in terms of being large enough. And they're not quite young and nimble enough where, they probably raised money at peak valuations and they thought they were just going to keep growing into those valuations, and some of them haven't. And so you see investors kind of put their chips on some of the younger companies that are most promising for growth reasons, or some of the older private companies that are promising for kind of value and survivability reasons. Phil, you probably see some more stuff on this.
Yeah, crystal ball, I would say there's just going to be more and more awareness of this space, even though we've been doing it for, 11 years or so. And really kind of the first wave of secondary liquidity for private tech companies was probably around Facebook, leading up to its IPO was probably the first time some, individual investors kind of popped their heads up and said, oh, I can buy these shares before it goes public. We're still in kind of the nascent stages, a lot of people don't even know this is even possible, that you can buy shares, on the private market. So I think there's just going to be growing awareness and a sense of urgency from investors. We talk about NVIDIA being a really successful public story. The fact of the matter is the number of publicly traded companies has gone down by something like 30 or 40% over the last decade, right? So the pool of things you can invest in the public markets is going down, which is crazy when you think about how big the markets have grown. But that kind of leads into the fact that NVIDIA is I can't even keep track anymore, $2-3 trillion company, right? You used to be able to buy something like Amazon at its IPO at a $475 billion or million dollar with an M market cap in 1997. So I think as that challenge persists and there's fewer things to buy in the public markets, you'll increasingly start to see investors look in the private ones. I think you'll start to see wealth management take more of a look, right? If they're getting their clients more comfortable with access to alts, are they going to take a look in the space? I think the answer is yes. And if you continue to see that the bar to be a public company just gets higher and higher, it'll take longer and longer for companies to go public, and therefore employees will have more and more urgency to get liquidity for cash needs, right? And most popular ones we see on our side on why someone sells, other than diversification, down payment on a house, paying down student debt, and those are parts of life, right, that aren't going away. So I think it's just going to be more and more market participants, and we'll soon see kind of this wave of new companies that have grown really fast in the private markets, as Atish alluded to. You got company like OpenAI that went from an idea to 86 billion in valuation in a couple years. AI has really allowed the steepness of how companies can grow in value, and people will need liquidity at some point.
Yeah, so here's I don't know if this is a curveball or not, but I feel like tech AI and blockchain crypto sort of go hand in hand. And I know on the real estate side, at least once a month, someone has a tokenization project where they're trying to take the real estate syndication market and provide some liquidity. So you guys have obviously done that in a more I don't want to say Wall Street friendly, but you've you're still with the traditional financial system, it seems, for the most part. But I'm curious what your take is on on crypto, and have you kind of done it without making it crypto, but obviously, built it with just in-house technology to buy and sell shares?
Yeah. It's funny. It was way harder in 2017 when crypto craze was really taking off, and ICOs were about to kind of launch, and it was really hard at that time to hold our ground and say, and almost be the contrarian and say, no, we're not going to do this. We're not going to go, chase the shiny thing right now. Even though it shows a lot of promise, does it have staying power? Does it have sufficient, resilience yet? We just don't know. And so our approach the entire time has been, first things first, we touch client money. So we take the bets we make very, very seriously. One of the things I like saying is, I would forgive Google Photos or whatever photo app you use for losing one of my pictures. I will never forgive Citibank for losing a single dollar out of my checking account. Like that, the trust relationship that we have when it comes to money is just so significant that we are relatively conservative. We're the cautious skeptics in the in an otherwise very brazen tech forward industry where we're saying we'll take risks, we want to move fast, but we're not willing to break things. And especially when it comes to client money, like breaking that trust is just so severe that it's just a risk we've decided not to take in terms of pursuing. Let's just experiment and let's just see how it goes. And kudos to the folks that have done that. Good for them. I think our ethos, our DNA, the clientele that gets comfortable with us is just folks that are like, I know my money's safe with them. I know what I'm investing in. I know I don't have to worry about reading a headline about what happens, and therefore I will go to EquityZen. And there's it brings up an interesting thing, Jack, kind of tying this back to what Phil was saying. Given where the market's heading and given where the excitement is, if you're, kind of a smaller investor, if you're an accredited investor, but you're still an individual, you don't have, $50 million in a family office, how do you navigate this potentially higher for longer interest rate environment? And that's actually where we've had some pretty interesting conversations because the cost of capital remains high. So any asset class, including alternatives asset class, but any asset class that's tied to rates, whether it's real estate or credit, you're kind of in need of a very high return if you're going to take higher risk. So if you think about what to do in an interest rate environment that's elevated, one of the things we've started to see is a lot of folks say, well, look, if the cost of capital is high, I need equity style returns in order to make up for the risk I'm taking. Like, why would I, in an environment where I can get 5% from the treasury, why would I settle for 7% on a much riskier asset? And instead, it's like, well, if I'm going to take the risk, I better get equity style payoff, asymmetric upside payoff, and that's where we've seen a lot of folks that are actually diversifying their alt portfolio. Folks that used to invest in yield products and rates products come up and say, well, in low rate environments, for me to get 7%, that made sense. But in high rate environments, for me to get 7, 8, 9%, I kind of need to have a portfolio of some high producing alternatives in order to kind of make up for the higher cost of investment, if that makes sense. I don't know if you've seen that or have heard that, chatter, especially with the higher for longer.
Yeah, certainly. And it's certainly been part of my mission and part of this podcast to get the word out there more about alternatives. I still think, especially in the 1 to 10, $1 to $15 million net worth, far too many just have 90 or 100% of their money just in like a 60-40 stock and bond portfolio, and just don't have anything outside of the traditional, they don't know where to look. And their advisor generally has no motivation to point them in a different direction. They're not allowed to sell anything that doesn't fit in their boxes, and any recommendation probably costs them money. Yeah. And you probably run into that sometimes too, where someone says, well, let me talk to my advisor. And of course they're going to say no, that they don't want that because they're going to lose assets under management if it goes to your platform.
Yeah. It's not on the shelf, I think is what we hear all the time, right? Oh, it's not on the shelf. It's not an approved product. We run into that all the time. I mean, we look at it, and the overwhelming majority of of the individuals that kind of fit in that net worth bucket that you mentioned, Jack, are self-directed investors, right? They're putting this stuff together themselves because they either have an advisor and they don't have too much access to alts, or they don't have an advisor at all, right? And they're kind of like the newer era of building their portfolio with alts and other things in there.
Yeah, and speaking of self-directed, I was just at a seminar, and I spend a fair amount of time looking into the tax efficient strategies as well, rolling over a company 401k to a solo 401k. And this type of investment to me is great for that retirement account money, because that outsized return, if and when you get it, it's only going to compound even further, and you don't have you're not paying capital gains tax if you reallocate. But I wanted to ask about it. I know you may have to be careful quoting specific returns, but you've had some of those diversified funds since 2015. So, if you look at the S&P return, 8 to 10% on average, I don't know, what can you talk about on maybe some of the sector specific funds on what those returns have been over a period of time?
Yeah. So can't share actual return data, but you should know that kind of the target and the goal for those funds is to certainly exceed the return profile of a public index, right? And that's in exchange, the investor should expect that because they're locking up their money for a couple of years. They're going into a higher and riskier asset, and they should be compensated for it. So our targets are kind of closer to what we see in kind of top quartile private equity or venture capital firm returns, which is usually somewhere in the neighborhood of 20% IRRs. So that's kind of what we're targeting for our funds. They usually have a 5-year life to them, so investors should know that it's going to take some time to harvest the returns they have in this vehicle. And you brought up a great point about using retirement money. So we have a lot of investors that use a self-directed IRA to make their investments. I'm sure you've seen this a lot on the real estate side too. It's the right tool for the job. It's money that you're not going to be able to touch till you're older, and so you should really align that that account with investments that are going to be illiquid, right? For things that you need cash for in an emergency, having publicly traded stocks is an easier mechanism. But for things that are more liquid, we typically see people a lot of times resort to their self-directed IRAs or 401ks to make these investments.
Yeah, so I got to give a shout out to John Heyer, who's a personal friend of mine, and he runs. He's one of the predominant IRA tax attorneys. So again, this is not my official legal advice, nor is John. This is for educational purposes. But one of the what I thought was just like an amazing efficiency that was recommended at one of his seminars is that if someone's going to invest into a fund that's not liquid and you want to invest at first with your IRA money. However, then if you want to convert to a Roth at that point, you could hire an appraiser to actually look at the asset, and they'll apply a discount for lack of control and lack of liquidity. So theoretically, someone could invest 100,000 into one of these index funds, sector funds, get basically an appraisal that says it's only worth 50 because of all these lack of liquidities, and then convert it into their Roth, and then they'll only have to pay the tax on a smaller portion. So this obviously gets a lot more complicated. It depends on your tax rate. If you're already a high earner in New York or California at 50%, it probably doesn't make sense. But if you just got laid off or just quit your job and you're taking a 6-month sabbatical, that could be a time to be really strategic about converting your IRA. So I just love loopholes like that. I just can't help but putting it out there.
There's a lot to be done in the alternatives world, and I'm glad that you're shining a light on it. Candidly, I'm proud of the work we're doing on it too. I think the number that I read recently is almost 10% of high net worth individuals actually will have allocation soon. Like it's almost 10% compared to the 30, 40, 50% for the ultra high net worth individuals. And exactly to the point you're making, Jack, it's funny how when you have a lot of capital, you can devote a lot of resources to become tax efficient. But when you're in this like in between zone where you have, some money, but not, such an obscene amount of money, it's hard to justify sometimes investing in some of these strategies. But exactly like you said, I mean, it's found money. You just have to put in the effort to try to convert them, and it's right there.
Great. Look, we could go all day, but I want to make sure we cover a couple of the key topics here, and I want to be conscious of your guys' time here as well. A couple notes I see here. Valuations had been down since the peak of 2021, but are they? I mean, you had sort of a run up at the beginning of this year.
Yeah.
Are they still down from 2021, or are they almost back up to the peak as the market's gotten close to its peak again?
Definitely still down, but that kind of makes sense, right? Because you can think of our markets to be more volatile than public ones, right? So when things were really good in 2021, things got even crazier in private markets. And when things soured and came back down to reality in 22 and 23, things got even lower in the private markets. And something we kind of gauge is we talked about how to value these companies in the private markets, kind of what's a good benchmark to use. And, typically the valuation of the last funding round is a good kind of line in the sand of at this point in time, this company's worth X. So a lot of times you look at where shares are trading on EquityZen relative to the company's last funding round and kind of look at it in the aggregate. And we've seen that number dip to as low as kind of a 40 or 50% discount to the last funding round. So things trading at half the value that they were marked at in, call it 21 or 2022, or where they raised money from. But we're starting to see that kind of on the uptick a little bit. So, fingers crossed, just kind of start to see those things kind of came to reality, and we're starting to see things come off the bottom a little bit. Private markets always operated a bit of a lag to public ones. Liquidity is part of it for sure. So we're starting to see some encouraging signs.
That's great. So I'm actually based down in Puerto Rico, and there's a lot of stock traders. I know a lot of guys who do secondaries. I know a lot of guys who do pre-IPO on small caps, et cetera. Are there? I mean, and we've talked a lot about just the basic accredited investors just trying to build a portfolio. Do you have market makers on there as well? Are there professional traders that are there to kind of provide liquidity on a daily basis, or is this really for kind of the buy and holds, and maybe a person is going to hold for 5 years, or if they really are going to sell, it's going to be a year or two later after a significant, change in the status of the company?
Yeah. So we don't do any market making. It hasn't really gotten to that level yet, partially because the transactions, compared to the public markets where it's a click of the button and it's an instant close, these transactions still have to get company approval each time. So our transactions are measured in weeks, not milliseconds. But what investors can do on the platform is, if they want to invest new, a company while it's private, and then they see some appreciation in value or some loss in value, they can actually still get liquidity for that while the company's still private. So we don't, Atish, you have a good term for this. We don't have day traders. We have, what do we call them? Month traders?
We have year traders.
Year traders.
We have folks who buy, hold it for a year, sell. That happens more often than we ever thought it would, actually. But that's the equivalent in our world. Folks that are not getting in and out quite as much, but definitely more active than the typical buy and hold investor.
That's great. So I guess I'd say there's room for the value investors. And I think for those that buy into the efficient market theory, it's much harder to be a value investor with public companies. There's windows, but I think for those that really dive into the research and have well thought out theses, there's room for those investors who are going to do a lot of their own research and make make smart decisions and smart bets.
That's right. And by the way, we do see some of that, right? Like we do have many clients that have a thesis, they have a list. At any point in time, you ask them, hey, what are you looking for? I've got these 5 names. If you have allocation, you let me know. And there's certainly people like that. And again, private markets are just, we think the line between private and public is going to blur, right, over time. And it's the same people. It's the same people that have access to public markets that are now coming, upstream to the private. And so at the end of the day, you're going to see similar dynamics, but to your point, it's going to take some time for the same behaviors to manifest.
Great. Quick question about profitability. I know most of this is like you lose money on every dollar, but you make it up in volume, and you just got to get public at all costs. But for these mature public companies, do you have any sense of like what percentage of mature private companies are actually EBITDA positive, cash flow positive, and just for whatever reason, just maybe aren't at the scale to go public, but they're a solid, profitable business?
Yeah, happy to take a shot there. So if you had asked me that question in 2021, I would have said close to zero. Really, the name of the game was leverage the 0% interest rate environment, grow customer base as big as you can, figure out profitability later. Fast forward a few years, and that tune has changed considerably. What a public market investor may look for by the time you IPO is not just, wow, that's a really incredible growth rate. They'll get profitable at some point. It's really, you need to show me a path towards profitability if you don't have it already. So good example, there's a company called Rubrik. It's a cybersecurity company that just started trading last week. I think a $5-6 billion valuation, something like that. And Rubrik's financials look very much like a much more mature company than you might have seen 2-3 years ago that went to market. We've got $600 or $700 million of top line revenue, but they're also cash flow break even on the operating side. If that company had tested the market a couple of years ago, I think they would have said, we're growing like a weed and we're going to figure out everything else later. So I do think the tune is changing a lot. I think the focus has changed. There's also been, changes and reductions in headcount across these companies. I think there's a big AI opportunity to streamline processes and improve the bottom line more and more. And we're seeing companies leverage that as well. So certainly think companies are gearing towards, let's get to EBITDA profitability, or else we don't really stand a chance of being a public company. And so that, I think, is a healthy kind of reset that Atish alluded to earlier, right? When things got a little nutty, we kind of lost sight of fundamentals, and now we're back in a better place.
There's probably one more thing I would add to that, Phil. I agree with what you said completely. But Jack, I want to clarify. Yes, venture typically is seen as you lose money on 9 investments, you make all your money back on 1 investment, right? That's true for early stage venture. The asset class we're talking about, like, these are not just always swinging for home runs. These are doubles and triples. And so, out of 100 investments that have exited, more than half have actually made money, right? And they haven't made 10x money. Like only 2 or 3 have made, exceptional returns. But you definitely don't see the type of loss that you see in early stage venture and what people typically associate with angel investing or early tech investing, because then you are absolutely just waiting for one fund returner. But what we're talking about is singles, doubles, and triples, and that just gives you a much higher hit rate. And candidly, our entire thesis on this is people know how to invest because of the Jobs Act in the earliest seed stage companies. Of course, people know how to invest in public companies. But this in-between phase, most people don't know about or don't know how to access it. And so you have slightly improved risk-adjusted rewards to be gained there.
That's a very good point, and thank you for clarifying that. And you'd mentioned private equity a few minutes ago too, and I think that's also sometimes a viable exit. Not every company goes public, but maybe it gets bought by Blackstone or bought by Microsoft or gobbled up by Nvidia as well, and then you have your liquidity.
Yeah,
Exactly.
yeah, and we've seen a lot of that in the last 6 to 12 months, and I suspect we'll see more of it, which is the company says, all right, it might actually take us a long time to get to profitability and do the IPO and everything, but Microsoft might get it, or Nvidia might get it, or Salesforce might figure this out, that this is a really great bolt-on acquisition and we can deliver profits to all our shareholders, our employees, to our investors, everyone. And this is a good landing spot. So we probably expect to see more and more of that happen as companies have accumulated a lot of cash too in the public markets.
Great. So finishing up here, walk me through. We've got a lot of investors that listen that are into these alternatives. If somebody wants to get involved, just kind of walk us through kind of the first steps to getting access to the platform and sort of what the first couple of days looks like if someone wants to dive in and see what you guys have to offer.
Yeah, absolutely. Well, thanks for the opportunity. So first you go to EquityZen.com, so EquityZen.com. You'd register. Our platform is only available to accredited investors, so you'd have to attest that you're an accredited investor. You have to go through some standard kind of KYC processes, some suitability questionnaires to make sure that it's a relatively riskier investment opportunity and that you're familiar with it. From there, you can basically start to browse. It's kind of like going into your Fidelity account and looking at different public companies based on sector or performance, and you can start to look at private companies that are available on the platform. And from there, you can evaluate if you want to invest in a single company. You could evaluate if you want to invest in a diversified fund that we kind of mentioned as well. And the nice thing is the process is completely digital and all done kind of on the platform. So you can go through and from start to finish, you can commit to a deal, you can connect to your bank account, you can sign documents, you can do your KYC process, you can get documents confirming ownership all through the platform. And typically, as we said, these transactions are measured in matters of weeks rather than milliseconds. EquityZen's there along the way to keep you posted about the progress of each deal, updates for the business, and then, fingers crossed, all the way towards some type of eventual exit for the business, right? Which could be an IPO or an acquisition, in which case EquityZen's going to hold your hand along the way to make sure you either get the shares of the now public company or you get the proceeds from an acquisition, tax documents, et cetera.
That's great. It sounds pretty simple and straightforward. And I know you can't really mention specific companies because of compliance, but I'd imagine there'll be some household names that most people would have heard of if they're paying any attention to the financial markets or the news.
Yep. Unless they've been living in a cave for the last couple of years, I think they'd be noticing that a lot of these names are ones they're familiar with. Kind of what we call like the blue chip of private companies, right? Ones that have been around for sometimes a decade or longer, that have become $5, $10, $20 billion plus valued companies, have real businesses behind them, but are just happen to be private. And that's where we see a lot of the interest. Atish kind of talked about it, but some of the most popular sectors right now are, unsurprisingly, AI, cybersecurity remains kind of a theme. I'd say some of the consumer consumer sectors cooled off a little bit relative to what we saw a few years ago. But these are trends; they evolve over time.
Yeah, that's great. We've covered a lot of good stuff there. Are there any parting thoughts here? Anything we didn't cover?
No, I think the only thing I would say is I'm really just excited that there's more and more awareness of alternatives, whether it be, again, credit, real estate, equity. And I'm sure as many of us try to espouse, the more diversification there is, even within the alternatives, the less susceptible we're going to be to any individual shock impacting the portfolio, which is why we try to get the word out not just to the venture-focused accredited investors, but also to the folks focused on credit, real estate, and other exotics out there. So with that, kind of want to say thank you, Jack, for the opportunity to to have a chat about this and to shed a light on another portion of the alternatives world.
Yeah, it's a real pleasure. I really like what you guys have built. I'm actually going to register myself as well. I've heard of you guys, but I just, for whatever reason, hadn't signed up. But I'm going to actually sign up and poke around myself. And really look forward to, I could have talked to you guys for a couple hours, a lot more questions. So maybe we'll do this again sometime. And we'll make sure we put all the information in the show notes, as well as far as your website and any social media channels that you're on.
Cool.
So thank you so much for joining us.
Yeah.
Likewise. Thanks for having us.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there, all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.